Hi traders, this is Fawad Razakzada, market analyst for City Index. Today is the 15th of August 2024. So it has been a risk-on day and equity markets are up across the board. The S&P 500 is now up for the sixth consecutive session. We've had some mixed data from the US in the last couple of weeks. On the one hand, inflation is weakening, which is boosting speculation that the Fed is going to cut interest rates, while on the other hand, some of the more recent data releases like retail sales data today, unemployment claims, and last week the ISM services PMI. All of these data releases have helped to reduce concerns about a hard landing in the US economy. So equity markets have recovered quite strongly following the unwinding of the carry trades, which were triggered by the Bank of Japan's hawkish rate hike a couple of weeks ago. But now we've seen the unwinding of that trade, and we're now back to where we began a couple of weeks ago at the end of July. So as things stand, we have reclaimed this broken trend line that had been in place since October, which is a positive sign, and key support at around 54.40 to 54.60 is now going to be a critical zone for the bulls to defend should we get a pullback in the next couple of days. Otherwise, if we can break through this shaded resistance area between 55.23 to 55.65, then this could pave the way for a potential move towards and potentially beyond the July all-time high at 5,670. There's a similar story for the tech-heavy Nasdaq 100, which is also reclaiming its trend line that it momentarily broke in the last couple of weeks. Now it's coming up to test this potential resistance zone at around 19,460 area. Should it close above this zone, then this could potentially pave the way for further gains, possibly towards the 20,000 level. Today's stronger retail sales data has helped to alleviate pressure on the dollar, which has bounced back after testing its lowest point since March in the last couple of weeks. But the underlying trend is bearish, and we've seen several lower lows and lower highs form. As a result, we've seen the 21-day moving average cross over the 200-day. Both of them are pointing lower. They have negative slopes. So given these technical indications, it looks like the path of least resistance on the dollar remains to the downside. Now, the dollar is going to trade differently depending on which pair you select. For me, the Australian dollar is right now one of the strongest currencies because we've seen stronger than expected data from Australia overnight in terms of employment change. This is the second month in a row that we've had 50,000 plus job gains in Australia, which is going to make it difficult for the RBA to cut interest rates anytime soon. So with that in mind, if we look at the chart of the Australian dollar, you can see that despite the strength in retail sales data from the US, the Australian dollar has recovered against the US dollar and is now testing its session highs. And resistance at around 66.35 to 66.45 area, the shaded grey area, which was previously supported, acted as a bit of resistance early this week. But now we're coming back to it after a strong recovery from the earlier lows. So the chart is looking quite constructive, and it has done so ever since it created that fault break reversal pattern against the April low a couple of weeks ago. And since then, it has been making higher highs and higher lows. So I think it's going to potentially break through this area in the next couple of days, possibly as early as today, and head towards the July high at 67.98 or thereabouts. So the path of least resistance on the Aussie dollar is to the upside, and we could well see some similar price action in other major currency pairs like the New Zealand dollar against the US dollar because of the positive risk appetite and despite the fact that the RBNZ surprised with a rate cut a couple of days ago. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.